Okay, we're live. So I'm gonna give it probably a minute or two for people to file in. What I want to do today is an AMA format. So I want to answer your questions. If you do want to ask questions, the best way is go to whatever channel this is on right now, LinkedIn, Twitter, and YouTube. So wherever you're watching, if you do have questions, you can drop me a question, and I'll be able to see it here on my phone, and I'm happy to answer it for you. So definitely drop your questions below. I have collected a few questions from previous days, and questions I was asking people on my newsletter and on social media posts and stuff. So I have some good questions compiled that we'll start with. But I definitely want people to, be interactive and ask questions. It is tax season, so this should be top of mind, and I'm here to help. So I'll give it a couple more minutes, and we'll let people get in here. But comment below if you're on LinkedIn, if you're on Twitter, if you're on YouTube. Comment below what are the most pressing questions that you want to ask a crypto CPA about your portfolio and or your business. So I'll give it another minute here, and then we'll get started with the first question. Okay. Sorry, I'm just getting my screens up here. Okay. So again, this is an AMA format. So if you do have questions, comment below. I want to answer, what's top of mind for you. Also, real briefly to anyone that's watching, I will be at Denver next week, from the 27th to the 1st, I believe. So if you are going to be there and you want to connect, let me know. Drop me a DM. I'm happy to try to meet up at the event as well. So I think we could start to get into the questions now. So I'll start with a question that I got yesterday as a LinkedIn comment. And this one was basically saying, I live in the state of Colorado. In Colorado, paying state taxes with cryptocurrency is legal. So if I'm paying my state taxes with crypto, is this a taxable event? And then he goes on to say that, some CPAs are claiming yes, some CPAs are claiming no. And to answer that question, I answered a little bit when the question was posed to me in a post I made online. But there's kind of a few considerations. So the first thing I clarified when I answered that was IRS versus state taxes, because obviously they're two separate things. Anything that the states do isn't necessarily going to impact the taxation at the federal level. So even if somehow those payments for taxes in crypto was exempt in Colorado, it wouldn't necessarily exempt it at the federal level. And to my knowledge, there isn't any exemption that is at the state level in Colorado either. Now, when I went on to explain that, what the commenter mentioned was, some people are claiming that you don't have to pay taxes on taxed money, and kind of trying to claim like if you're taxed on money that you're paying taxes with, it's double taxation. Where really, if you pay taxes in crypto, and this is something that I warn people, like if you're going to pay your taxes in crypto, it's likely going to lead to a taxable event. If you pay your taxes in crypto, you're not getting taxed on just the tax payment that you're giving them. You're getting taxed on the disposal of that asset. So they're going to look at, the price that you paid for it, and then what was the price of it when you disposed of it, when you paid your taxes. You're only going to get taxed on the difference, on the price appreciation, which hasn't been taxed in past transactions. So it's not really going to double tax you, but it is going to create another taxable event, another administrative burden from an accounting perspective. So you gotta tread carefully and really decide if it's something that you want to do, paying your taxes in crypto. So let's see here. Hey Thomas, how are you? So can you speak a bit on the differences between businesses struggling with the tax implications of using crypto operationally and as private investors? Yes, I can. So, one of the first things I see is that like a lot of times like people that are individually just have an investment portfolio, for some reason they want to get set up with business entities because they think it's going to lead to, tax breaks for them, or, some sort of tax benefit for them. And I usually find that that's not the case. The other thing I see is that people with, closely held small businesses that are just usually just, like service-based businesses that are passing through most of the income to themselves. Sometimes they'll come and they'll start to ask like, should I put crypto on my balance sheet? Those types of businesses, I don't really see a benefit to them doing that. If they want that exposure, they can just take it personally in most cases. Now, crypto businesses that we work with, like Web3 businesses that are actually, operational businesses that are transacting in crypto, they have a lot of nuances that they have to deal with, to getting a proper accounting system established, to making sure that they're tracking all the taxable events, especially if they're doing a TGE. There's usually going to be some unexpected accounting and tax needs to them from that standpoint. But yet using it as an investor in a business are two very different things, and you want to keep them separate. Another thing I see a lot is commingling of funds with early Web3 startups. So when people are first getting started, they may have a wallet that they're using for personal and business purposes, and it just makes it a complete mess from a tax and accounting perspective to sort that out for them. So those are a few points for that. If I didn't hit that question perfectly though, if you wanted to clarify it more, I'm happy to circle back to it as well. Let's see here. So another question that I've been getting a lot is on the 1099 DAs. I'm still seeing a lot of people that aren't even aware that those are going to be coming out. So I did want to address that. Basically, we are going to see 1099 DA reporting for this tax year. It's going to be limited this year, but we are going to start to see that reporting go out, and I think that's going to have several implications for people. Number one, there's still a 75% non-compliance rate according to the IRS, so there's going to be a lot of people that get that tax reporting, and it may make some of them start. It may be sort of the reason that some of them start reporting. I'm anticipating that not everything on these reports for the first year is going to be accurate either. So making sure that this is reconciled appropriately, I think, is going to be key for taxpayers. So let's see here. Okay, Thomas. So related to tracking sales tax liabilities. That's a great question. So sales taxes is something that I'm seeing going widely overlooked. It feels like crypto taxes to me in 2016. It's something I've been very, very focused on. I wrote a book on it. We have a software solution for it for people that need to collect sales taxes on chain. And it's something that, most marketplaces, most NFT sellers, most people with on-chain transactions, I believe are overlooking. It's a new emerging tax issue. Ultimately, if you are transacting on chain, you may very well have sales tax exposure if you're a business that are selling on chain. So it all depends on what you're selling. Standalone NFTs do have sales tax exposure in some certain states, including Washington State as an example. And then other NFTs that may be representing other digital or physical goods or services can also potentially have a sales tax exposure based on the underlying nature of the NFT and what it represents. Outside of that, if we do start to see more commerce move on chain and more people just transacting for different types of traditional goods and services on chain, you're not going to get out of that sales tax exposure just because it's on chain. Just like, during Wayfair, you didn't get out of your sales tax exposure just because it was online. So to me, this is a huge emerging issue that I believe many Web3 businesses, if not most, are not compliant with right now. And the steps that they need to take to get compliant is to, start by doing a compliance assessment to see, like, based off of the assets you're selling, based off of where you're selling from and where you're selling to, where's your potential nexus and tax exposure going to be. And then from there, you need to get a good system to properly collect all of this information from your customers at the point of sale. You're going to have to collect their address, their wallet information, and other information in a scalable method in order to accurately calculate that sales tax at the point of sale, so you could properly collect and remit that from them and stay compliant. And then you need to have reporting done all on the back end for all of that information. And then everything needs to get reported to the sales tax agency. So we do have a system for that. But yeah, I would say, like, it's something that's going widely overlooked. And I think it's going to become a bigger tax issue that gets more focus as we move into the future here. Sergey, you say for capital gains or losses, the decision between LIFO and FIFO is year by year or by asset. Answering this question gets a little convoluted, because first I have to start to understand, like, are you compliant with Proc 2024-28? Have you transitioned to account-based reporting? Are you leaving standing orders, documenting standing orders across custodial and non-custodial wallets? So firstly, FIFO is the default accounting method when it comes to cryptocurrency accounting. And if you're going to select a method that isn't FIFO, it's going to be under spec ID. Spec ID is specific identification. So if you're not operating under FIFO, you need to comply with the requirements to do the accounting under specific identification. When you're operating under specific identification, you can leave what's called standing orders and document them in your non-custodial wallets and leave them with brokers starting in 2026. When you leave standing orders, you can select an alternative accounting method, such as LIFO or HIFO, but this has to be done before the transactions take place. So you can't like go through the whole year this year and then get to the end of the year and just say, I'm going to choose HIFO. You would have needed to document that before you made any transactions for whatever asset that you want to apply that accounting method to. So I think, that is the big key in terms of selecting an accounting method. You need to decide, are you going to default to FIFO, or are you going to start documenting your standing orders? And then if you do that, you need to make sure you're proactive with that, or you're going to get defaulted from FIFO. The other question is, when converting from a token to a stake token, is a tax event triggered? This is not totally clear in the tax guidance as it stands right now. The conservative tax treatment is that yes, this is a taxable event because they are two different cryptos with different risk and liquidity profiles. And when you trade one crypto to another, since it's property, it is a taxable event. So at our firm, we do treat them as taxable events. You may see some more aggressive tax positions that are going to claim that they're not taxable events because they're more or less the same asset. Let's see here. Let's see. Sorry, my screen's got a little jumbled here. Just trying to check these other channels. Okay. So I'm getting another question on this revenue procedure. Like, what is it? It's basically done two things. It's like I said, it's requiring standing orders. So you're defaulted to FIFO if you don't leave standing orders. And the main goal of that was to stop abusive tax practices where people were selecting HIFO on a universal method and creating inaccurate audit trails to support their transactions. The other part of the revenue procedure is account-based reporting. And it somewhat goes to stopping that abusive tax practice, but it's also trying to align taxpayer reporting with third-party reporting that we're going to see with the 1099 DAs. So as of December 31st, 2024, you have to switch from a universal accounting method to an account-based method. So that means you need to have your cryptocurrency accounted accurately through 2024 on the universal method, if that's what you were reporting on and using in past years. And then once that's calculated, you need to allocate that calculated basis to where those assets are actually held across exchanges and wallets. And there's a prescribed methodology to do that, and you need to do it in a consistent manner. And then going forward, the accounting methodologies are not going to just be applied on an asset by asset basis. They're applied on an asset by asset basis as well as an account by account basis. So I believe this opens up tax planning opportunities, and that's something that we're working with clients on, that we've taken through this allocation process, and now we're to the next stage to where they have these assets that they're holding across wallets and exchanges, and they have different bases, and we're working with them on being more strategic about how they manage their flow of funds on chain, because now it can have much different tax implications. If you spend Ethereum out of wallet A versus wallet B, those can have two very different tax outcomes depending on the basis that's sitting in each of those wallets. Whereas under a universal method, that wasn't as big of a concern, because there was just an accounting method getting applied on an asset basis. So that's basically what the revenue procedure is. So if you haven't switched over to that account-based tracking, it's key. And then, there is an administrative burden to doing it, but there's also potential tax planning opportunities outside of once you have it set up, there's tax planning opportunities outside of that. So let's see here. So Thomas, you're asking a good question. Implementing adequate internal controls. So yeah, this is a big topic for Web3 businesses. You're going to have several different people that are involved with the company, and you need to ensure that your protecting the integrity of your company and the integrity of your assets. So, some of the things with internal controls, I would say, is segregation of duties between like initiation of a transaction, authorization of a transaction, the custody of the transaction, the recording of the transaction, having access controls around who can access certain wallets and private keys, and just having like strong passwords and multi-factor authentication, and then transaction monitoring. So having something that you're able to monitor like any large or unusual transactions that are taking place, or on unauthorized transactions that are taking place. And one important aspect of all this is to regularly be on top of your accounting and on top of your books, because that is, your financial statements are that source of truth for you to see what's happening in any given period related to your business operations from a financial perspective. So regularly keeping your accounting up to date, reconciling it, I think is also a very important step. Let's see here. So now I'm getting a question on what are the tax implications of accepting crypto as a payment for good or services. So there's a few things that you'll want to consider there. Firstly, if you're accepting as a payment for goods and services, it's going to get taxed as income based off of the fair market value of the day and time that you are receiving that asset. Additionally, outside of just your income tax exposure, depending on your if you're just self-employed or your entity structure, there may be a self-employment tax exposure that's going to really get situational. And then once you have the income from that asset, that's going to establish your cost basis in that asset. And then that cost basis, if you later sell that asset, will reduce any gain or loss related to the proceeds of that sale. So you have a few different tax exposures: the income tax exposure, and then if you hold that asset for any period of time before you sell it, there'll be a capital gains exposure as well. Outside of those tax exposures, you're also going to have the sales tax consideration. If you're selling a product, good, or service on chain that has sales taxes applicable in that state, you will likely have a sales tax exposure as well. And for you to comply with this, you're going to need to collect information from your customer, including their address, to get rooftop accurate rates. So those are the big considerations. Obviously, if you are a business that is accepting crypto payments, you need to get a strong accounting system set up, a strong compliance system set up, including a sales tax software if it's applicable to you, to make sure that you're in compliance and that you're tracking your activity. I agree, Thomas. I do find that updating the accounting does tend to fall behind. And I think internal controls is something that a lot of these Web3 businesses need to work on, and start to reach new levels of maturity with it. The accounting is extremely important, but it does kind of fall on the back burner sometimes for these companies. Someone's asking the best accounting software for Web3 businesses. What I would say there is, it's not a one size fits all approach. I actually got this comment the other day on LinkedIn that I thought was really interesting. Let me see if I can find it real quick. If this takes too long, I won't dig for it. But basically, let me see here if I can find it. Man, I get a lot of more notifications than I realized. All right, here it is. So someone was like, let me guess how your process works. First, you'd ask me to sign up for a Web3 subledger, and then you'll get a referral fee for it. And then you'll tell me they don't support all my chains, and then I'll have to pay you to manually code it all. And then we'll get a year into this and you still won't have it accurate. Now, obviously, that's not our firm's process. But I think this individual was highlighting something that I hear a lot and that I think is happening a lot industry wide. Our firm is software agnostic. So we're not going to just work with one software and be married to them. And we don't take referral fees from any of these softwares. So we can put ourselves in a position to really recommend what's best for your business. And that's usually where I start with a Web3 business, is going over, what is the nature of their business? What does their on-chain activity look like both now and what they're planning for in the future? And really trying to find what is the best subledger for them to get set up on, considering things such as blockchain coverage, reporting capabilities, integrations, pricing, customer support. All these things are going to factor in. And if you do that from the start, for a lot of companies, you're not going to run into these issues where you don't have the chain support because you check that ahead of time. Now, if someone is on a very obscure exchange that no one supports, of course, you're going to have to do some manual data integrations for that. But that's usually few and far between, I would say. And when it's needed, that's what you're going to need to do if you're on an emerging chain. But there's some softwares out there that have very wide coverage on blockchains, and some that have very tight coverage, and they're not focused on competing on that chain coverage. So I think, like, overall, like, what is the best Web3 tax software? I wouldn't even say we recommend the same tax software for every client that we work with. We really take it on a case by case basis. We look at the nature of your business, both now and where you're going in the future, and what your needs are, and try to narrow it down to the top 2 or 3 softwares, and then help arrive at a selection with you based off of that. There's many accounting softwares out there. There's almost as many accounting softwares as CPAs nowadays. So you have many to pick from. But the key is to find one that works for you, and then to invest the time into it. Because the other thing is that none of these systems are perfect. So it is going to require a time investment from you or your CPA or your CFO to ensure that these systems are set up properly and also maintained properly. Let me see here. So I think we're probably going to wrap up here soon. If there's any last minute questions, though, I'm happy to go over them. So everyone, you could drop your questions below if there's anything else that's top of mind here. And what I'll leave you with is that, tax season is gearing up. It's here. And, there's been tons of tax changes. In my firm at Camusa CPA, we're actively working with crypto investors with complex portfolios. We're cleaning up their accounting. If you have to go back to 2016 and clean up your accounting, we're doing that every week. We're dealing with the delinquent returns and the amended returns. And, we're helping assist with tax notices related to unfiled crypto transactions. So if you have any of those needs, if you need to get your crypto accounting cleaned up, if you need to get your taxes filed related to crypto, if you're getting tax notices from the IRS, or if maybe you've gotten all those things in order and now you want to look at strategically tax planning for your cryptocurrency portfolio, these are things that we can assist you with as an individual cryptocurrency investor. On the other side of things, if you are a builder or a Web3 founder, we can assist you as well. What we're helping Web3 businesses on is getting their accounting systems set up, helping them select the right software stack for their accounting system, maintaining their accounting system on an ongoing basis. In addition to that, we can help you on the tax and the CFO side as well with strategic tax planning as well as tax preparation. We're helping a lot of Web3 companies that are going through TGEs and they need strategic tax planning. They need to make sure that their accounting systems are ready to deal with the nuances that are associated with those types of transactions. So if you're a Web3 business, if you're an individual investor that needs assistance with accounting or taxes related to your on-chain transactions, you can visit my website at camusocpa.com, go to the contact us page, schedule a time to sit down on a video call just like this privately between me and you. We'll discuss your business, we'll discuss your portfolio in detail, and then I'll see if there's a good way for us to work together. And hopefully down the line, my firm will be assisting you with your accounting and your tax needs. The other thing I'll say is if you go to my website on the resources page, there is a downloadable checklist, the ultimate cryptocurrency tax checklist for 2025. Go and download that. Even if you're self-managing your accounting and taxes, or you're working with another CPA and you just want to make sure that they're not leaving any box unchecked, that will be proved to be very useful for you. So I encourage you to check that out as well. So to everyone that tuned in, I really appreciate the support, and to everyone that asked questions, I very much appreciate that. So shout out to everyone that asked questions, including Thomas and others. Thank you very much. So I think that's about it for now. Keep an eye out for some webinars that we'll be coming out with here very shortly, as well as other new forms of content that you'll see me posting across LinkedIn and Twitter and YouTube. And we'll be staying in touch. So until next time, I'm Patrick Camuso.